Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at the market site in Times Square, New York City, we have Kathryn Kaminski. She's the Chief Research Strategist and Portfolio Manager over at AlphaSimplex Group. We're going to take a look at cross-asset trends and the market volatility that we're seeing. Are we in crisis or correction? It's great to have you with us at Market Site. And that's really the question everyone is asking. Is this a correction? Was this expected? Or are we really in a full-blown crisis?
Yeah, perfect. I mean, so if you think about a correction is a very short event where you have losses and then they get recovered in some sort of way. A crisis is a sustained period of losses. And this is precisely what everyone's concerned about the long-term impact of that type of event on, and its ability to have feedback effects. But let me just turn to the markets and tell you a little bit about what we've seen and some of the things as a cross-asset trader that we think about. So if you look as far back as January, we saw a lot of very strong trends in assets outside of equities. For example, we've seen energies take a massive hit. We've seen commodities also be under pressure. We've also seen a large move in fixed income that has started as early as mid-January. And we've also seen the US dollar surging as well through some of this wake. Ironically, the equity markets were somewhat late to the game, and you saw a lot of complacency before the 24th. Right now, what people are trying to figure out is, where are we going from here? And I think that's quite, it's not clear.
Yeah, and I think it's also tricky because is this based on emotion? Is it based on fundamentals? Because this isn't something that's specific to the financial markets where, like in 2008 and 2009, this is something that the average person can identify with when you're looking at a medical crisis. So what do you think? Emotion, fundamentals?
So the thing is, any of these type of events, when we're sitting here thinking about the markets, we're always thinking, what if this is emotional reaction and what if this is actually driven and actually by pure fundamentals? So in markets like the oil markets, we have seen the direct fundamental impact. We've seen the fact that supply has been a problem, that oversupply is an issue. And so I think if you start to look at markets like the commodity markets, you can see where this has already had an impact. It's a little bit more clear, that impact. But in terms of emotions, to be honest, one of the reasons people ask us what we think is that as a systematic trader like myself, I have a lot of emotions, but they're not part of my investment process. And I think in those moments precisely, that's when we need to have a process. We need to think about how to measure what's going on in the markets as opposed to react on our gut. Because honestly, this type of event is the type of event that's affecting everybody. And even people who aren't in the financial services are thinking, they can understand the fear of this type. And so I think that is what's particularly poignant about this environment.
And as a cross-asset portfolio manager, you're in the largest markets in the world. I mean, commodities, of course, fixed income is a tremendous market. Do you think a lot of this could be computer-based trading? I mean, how can portfolio managers adjust their position so quick to go with these moves? I mean, we're down, between 9:30 and 2 o'clock, we could have 1,000-point swings.
So this is what concerns me about these type of moves, and it doesn't necessarily say anything about I know who's trading, but when you think about the market as an ecosystem, there's a lot of market participants out there having different views and having different beliefs. In an environment like this, when things are moving very rapidly and we have 4.5% days and then 2 down days and then down 3 and up, huge numbers that we're not used to having, that tells me that a large group of people are moving in the same direction, which in general, regardless of who they are, is not a comfortable environment for us as a equilibrium. It's not feeling like an equilibrium. It's feeling very much like nobody knows where to go. And that is what I think concerns me the most about it. I don't know who,
right?
It's hard to determine who's the person that, there's no culprit. I think it just has to do with behavior.
Right.
People are behaving in a very coordinated way, whether it's through their systematic trading or whether it's through their emotions. People are definitely up and down quite a bit in terms of what they think is happening.
Because certainly one thing markets don't like, we can all agree on this, no matter what asset class you're in, is uncertainty. So I think the more this is prolonged, not even just through the coronavirus, but we have a very contentious election coming up, and part of the bounce that we might have seen could have been attributed to Biden, but it feels as if this volatility might be one of the more prolonged environments that we've seen certainly over the past 5 years, for sure.
No, I would have to agree, because I think the challenge with a crisis is there's always a core risk that we didn't understand. And if you think about 2008, there was some sort of risk. There was a risk in the banking sector. But in this situation, it feels like there's a new event, there's a new challenge for the markets that we've never had before, and therefore we need to, it's going to take time for us to figure out what those risks are, how serious they are, what their potential impact is. And I think, you know, it's not something that we just brush off.
Right. All right. Kathryn, great insight. Thanks so much for joining us at MarketSite. And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.